Let's go for the first story now. And the Association of Oil Marketing Companies, AOMC, is blaming the upsurge of illegal fuel trading for the poor sales of oil marketing companies in 2017. The coordinator of the association, Kwekwa Jimandua, says sales per month last year was 50% lower than the previous years.
Exactly how would you describe 2017?
It was pretty bad for us. It was very, very bad for us. For instance, I could tell you often that averagely we expect each average outlet to have sold about 150,000 liters per month. We got about half of that, 77,700 liters per month. Can you imagine? We were having the incidence of illegal fuel, and we have safety issues as well that we have to contend with. And certain agencies were trying to trample on our basic rights by trying to close those stations which they're not supposed to close. And it's not been easy. And,
why would you say that your sales was halved?
Basically, the illegal fuel had a serious impact on us. Even though we would like to commend the economic management team and the security agencies and our regulator, MPA, particularly Hassan Tampori, Chief Executive of MPA. He did very well in trying to stem the tide of the illegal fuel. And I could say that even when people were doing illegal fuel, they had to move. Getting to the latter part of the year, they started to shift the illegal fuel now to bunkering. He still stood steadfast to it. We are hoping that security agencies, in conjunction with the economic management team and also MPA Chief Executive Hassan Tampori and his directors, could help us as we move towards this new year, continue to be with us so that we can stem the tide.
Meanwhile, the Association of Oil Marketers is projecting some volatility in prices of petroleum products this year. Coordinator of the association, Kwekwa Jimandua, fears the persistent fuel shortage in Nigeria means importing from other sources into that country. In an interview with Joy Business, Odilia and Tiamwa, he explains the situation has resulted in more crude oil vessels preferentially offloading in Nigeria rather than Ghana. He says Ghana will have to pay more premium to attract these vessels, and this will certainly affect pricing.
Because of the competition that we're having, some OMCs and FPGs are competed among themselves so much so that their margins are even eroding. And it's not good for all of us, because what it means is that the tendency to sacrifice safety will be there. So we need to gear up. So as we think about the export price, we need to think about how effectively we can have the margins to a sustainable level in spite of the competition, so that we'll have better service for our customers.
You were saying that also Nigeria's lack of fuel currently has also affected or is likely to affect prices this year.
Yes. Nigeria had a shortfall at scarcity of the petroleum products during the next months. And Nigeria economy is big. And usually we need to have that kind of, I would say, relationship with Nigeria. Some of the vessels go into Nigeria or pass here with supply. So once they have that, they become obviously the preference destination. So as we get the fuel, we need to factor that one in. And that may have effect on the pricing. Because if a lot of them are going there and you want them to come here, they need to attract some amount of premium to be here.
So exactly how would you describe the fuel market for 2018? Are we going to have volatility, or we're going to have some stability?
I like the first one. It has always been volatile. The only thing that is going to be volatile, but we believe that this is where we expect the government to support and cushion us as we move along. We talk about the taxes. We need to have the taxes in such a way that there's a lever. When things are going up, we try to bring it down so that we all have a respite. When the prices go too high, it's not good for our business, because people start rethinking how efficient it is to use their fuel, and they don't buy the fuel as much as they are supposed to do. So we really, the volatility will be there, but we expect that the government could intervene one way or the other.
Let's still stay further in the downstream petroleum sector, where the state oil refiner Tor yesterday resumed production after a 10-month break. The company is now producing 25,000 barrels of oil per day. This has, however, come with some mixed reactions by some industry players. According to the energy think tank IES, it's important the government takes steps to revamp the refinery and do the needed retrofitting in order to produce for local market standards. Speaking earlier on the marketplace, researcher of the IES, Richmond Roxon, also advocated a transformation of the Tor debt recovery levy into a fund to help revamp the company.
It's been there for a long time, in fact, over a decade, and we haven't had a comprehensive account of how much we've made over the period, how much has been paid and how much. In our opinion, we don't think that the Tor levy should be there. If it's going to be there to help the expansion work of the refinery, definitely that's. If it's going to go into the payment of debt, as has been over the years, that there's no business for it. Already, government has said notice that it's going to apply all the energy sector. Already, we've had some 4.7 billion coming in. We are looking forward to the other half of 1.3, together with the balance of 4 billion that government was expecting. Because in general, we're expecting around 10 billion. The challenge is that over the years, if government takes these funds, they don't channel it into what we expect them to do. So we would suggest that even if we are going to have the Tor recovery levy being there, we should have a trust to be able to manage the fund. Once it's going to the consolidated fund and it's being managed by the same Ministry of Finance and going to a government coffers, definitely the funds will be diverted. We know governments always needs money for certain projects. So yes, we agree that if we look at rechanneling the funds into other areas like expansion and retrofitting, that's good news. But at the end of the day, we can't have the same people managing the fund. We should be able to find a way to have a trust to manage the fund so that the funds will go into exactly what we are expecting it to do. Because we've taken Tor recovery levy for over a decade, and up till now, Tor still owes, which is pretty amazing.
Moving on, Enterprise Insurance boss Kelly Gajepo says the company is raising $50 million this year with the focus of taking up insurance policies in the oil sector. He adds his company is overcapitalized and not therefore bothered about the National Insurance Commission's current desire to increase recapitalization levels.
We are not even flinching. We ourselves are quote-unquote overcapitalized as we speak. And as you're aware, we are raising even more capital very early next year. So I'm not sure what numbers the National Insurance Commission may have in mind. But we are raising over $50 million in a few months just for our own business ambitions. So no, we are not even concerned.
Will that involve your heavy involvement in, for instance, the oil sector?
Yes, we want to have the kind of balance sheet and ability to do more and to have a strong presence in oil and gas in Ghana.
Exactly what are your current state when it comes to insurance services being given to the oil sector? Exactly what have you done so far?
Currently in Ghana, it's all pooled under the pool, the oil and gas pool. But I'm sure that cannot be a permanent arrangement, especially if people are able to develop the right size balance sheet. We should be able to take some risk on the right appropriate risk on our balance sheet. So we are gearing up for that for the future.
Let's now move away from the petroleum sector. And government ended last year meeting most of the macroeconomic targets set out in the 2017 budget. There's more in the following Business Desk report.
According to the 2017 budget, government was hoping to end the year with a budget deficit of 6.3%, inflation rate of 11.2%, total expenditure of 55.9 billion, and gross international reserves of 3 months of import cover and total revenue of 43.1 billion cedis. However, checks by Joy Business with the relevant institutions that handle these numbers show that with the exception of revenue, which is still facing some challenges as at November, government is on track in meeting most of these targets. Economist Dr. Eric Osesibe is however optimistic All these targets will be achieved if end-of-year estimates are released by the end of the first quarter of this year.
Inflation is likely to end the year at about 11.2% as was projected. The fiscal deficit of about 6% is likely to be the case. GDP growth rate is likely to even exceed the target. Monetary policy rate is on the downward trend, treasurable rates, and all of that. So most of the indicators are on the right track, and therefore, unless there's any big shock, to the economy, I do not think that we're going to deviate that much from it.
For some analysts, meeting most of these targets could revive donor and investor confidence in the economy, an indication that government is committed to sticking to these numbers to achieve the required fiscal discipline.
The Social Security and National Insurance Trust SSNIT says it is currently working to help some banks that the company has some interest in to recapitalize. This follows the submission of a plan by the commercial banks on how they intend to meet the 400 million cedi minimum capital requirement by December 2018. The State Pension Trust currently holds significant shares in GCB Bank, Carl Bank, Ecobank, HFC Bank, Standard Chartered Bank, and Societe Generale. Director General of the SSNIT, Dr. John Ofori-Tinkwang, has been giving details of ongoing discussions with some of these banks.
We have shares in several banks. The banks have approached us with some of their plans. For those that we feel like we don't want to be diluted, we will follow our rights if there is a rights issue. Some of them are talking about not paying a dividend and using part of the dividend to recapitalize. So, we support some of these initiatives. And then there are others who also want to spread their wings and extend their territory. So they are in discussions with other banks to get together. As you can see, if two banks can get together, combine their capital base and do the same amount of business, your return on capital, becomes good. So we would also support plans for consolidation. And I think there's going to be some consolidation on the way.
When there are cash calls as well, you meet them as a shareholder.
Yeah, that's what I talked about as a rights issue. So if you made a rights issue is made and we want to keep our interest, and that investment has to make sense for us, right? So if it's an investment that we want to keep our interest, yes, we will. And even if it could be a case where we even want to increase our stake, and there's an opportunity to do that, we will consider that also.
Let's now get into the world of cybersecurity. And would you want the kind of processors in your laptop or computer in the office? Well, if it is Intel, then it is at risk of being hacked. It follows a security challenge in updating that component. The development could put several banks in the country at risk, as well as sensitive institutions. Now, government is being urged to channel funds meant for the flagship programs through the rural and community banks. The Planting for Food and Jobs and the One District, One Factory initiatives are expected to absorb millions of dollars in funding through its implementation. Industry players believe this could serve as a financial base to support the banks in their capitalization process. Prince Appiah has been speaking with Joseph Akosi, an expert in the rural banking industry and a consultant at Proven Trusted Solutions in Kumasi.
Currently, we are here to speak to Mr. Joseph Akosi, industry expert of the rural banking sector.
We sincerely apologize for the poor quality sound. But still in Kumasi, traders within the Central Business District of Edum are pleading with city authorities to hold on to the upcoming decongestion exercise until completion of the Kejetia redevelopment project. They believe it will reduce the impact of any forceful eviction. The plea follows a hint by City Mayor Osei Sibe Entry for an impending exercise to move traders off the streets. Love FM's Kwesi Debra reports.
The Central Business District can be said to be empty, and there's a semblance of sanity. Motorists and pedestrians appear to enjoy less stressful movement than they did ahead of Christmas. Traders who reluctantly vacated the streets and pavements a few months ago on KMA relocation order are gradually coming back. Akusuejiwa sells towels. She's among traders who were asked to move to trade at the racecourse market.
At the Abinchi, they couldn't buy anything. That is why I have returned. She says they can gather us around designated places to sell.
Consumer goods seller at the Kumasi Zoo area, Grace T, shares similar experience.
It's hard selling at the Abinchi, so we had to come here, she says.
Grace is not alone. Kwesi Akowa, a shoe seller, also couldn't cut success there. He's back at the forbidden site.
I've been trading here for many years. It's good to do the decongestion, but the government should find ways to help us. We couldn't sell anything at Abinchi and Racecourse to celebrate the Christmas. We have children and wife to...
The combined police and military operation to rid the city of unauthorized structures also took a toll on commercial drivers. They have also found a site within the parking spaces to load passengers. They are charged 1 cedi every hour.
The cars are many here. We have to wait at the Methodist Church area before it's our turn. This place can take 3 cars at a time.
The situation has narrowed the road, and this has resulted in several crashes. The Kumasi Metropolitan Assembly will embark on a decongestion exercise possibly next week. The traders and drivers had enough of it. They are only pleading with authorities to wait until the Kejitia project is done. Reporting for JoyNews, Kwesi Debra.
And you're on Business Live. Time now for the interview of the day. Chief Brand Officer for International Transport Services Uber, Bozoma St. John, says Africa will have to embrace technology in its transport sector to open up the continent for more businesses. She spoke exclusively with Odilia Ntiamwa.
Interview of the day.
At the end of the day, it really takes your own self-startership, in order to really break through, because you're the one who's doing it. You're the one who's in the office every day. You're the one who's going to see the opportunities. And so it's really at the end of the day about yourself. But make sure that there's a good sounding board of a good village around you who will help support.
And being disruptive, especially when it comes to the area of technology, exactly how would you talk about that in relation to developing businesses and especially startups in this part of the world?
Well, disruption is a really key word for innovation. When you don't create something completely and totally new, right? Even if it exists already, take it apart and put it back together in a completely new way. That is disruptive and what is comfortable for most people in that it creates.
Interview of the day.
And it's been so wonderful being my guest on the show tonight. Business Life was the show. My name is Emmanuel Abuaji. If you make a date again, same time tomorrow. Have a good evening.